Howdy, howdy. Good evening, folks. I've got a phenomenal guest for you all this evening, and I cannot wait to introduce him to you guys. All right. Should be joining up here in a minute. Yes, sir, skis. Yes, sir. Yes, sir. Here he is. Here he is. Oh,
How we
no.
doing, guys? How we doing?
How you doing, Beast?
Whew. I'm excited to be here.
Yes, sir. Thank you so much for joining us tonight. I'm very, very much appreciate your time, and I'm glad that we get to sit down and we get to chat. So, guys, this is a gentleman that I am so excited to speak with this evening because he's very similar to me. We have a lot of similar theories, thoughts, ways of trading, mentalities, thought processes, but we go about our similar thoughts in completely different ways in the market. So I love that. And a lot of guys in my server have been asking for a short-term trader version of Clayton. Well, he might be far past what your expectations are, but he definitely fits a little bit of that mold. So I'll let you introduce yourself, and thank you so much for your time again.
Thanks, Clayton. Guys, so I'm Royal Market Burglar. You guys, Clayton's going to call me Ethan during the live stream. A lot of people either call me Royal or Ethan. I've been trading for about 6 years, mostly options trading. I do mostly short-term trades and short-term swings. All options nowadays. I started off trading in crypto. Made a lot of money during that first bull run into 2017. Took all that money and put it into a trading account, bought some long-term stocks, and then I took all those long-term gains, opened up a options portfolio, and was able to day trade options left and right, and that's what I do now. So what I trade based on is a theory called levels don't lie. It's basically you find major institutional support and resistance levels, and you only play off of those levels. And what you're looking for is you're looking for small scalps at the top, and then you're looking to swing the rest for a day or two. I do play weekly contracts, but I try to limit myself to monthly contracts as they have more OI and more volume. So I hope that gives you a little bit of an intro into what I do. Outside of trading, I also do private equity and sales for 2 other companies, but we don't have to get into that since this is going to be about trading tonight. But really excited to teach you guys a little bit about how I trade.
I appreciate that very much, and I'll give a little bit of an intro because I am not the focus this evening, but I want to give you guys a little background on me. I look at the same perspective as Ethan does. I very much care about the institutions and how they trade, the big banks, hedge funds, etc., and how they trade. So I'm always looking at major time frames. I'm always looking at higher time frames, and I'm a long-term trader. You will not ever catch me unless there's an opportunity that I cannot pass up trading under a biannual expiration or a biannual time frame, including equity or a multi-year time frame for equity specifically. So I trade long term. I leverage larger movements in the market, and I'm part of the retail community, but what I focus on the most is the banks and the institutions. So that leads us to our first topic at hand for this evening. We wanted to talk about the current condition of the market as comprehensively as we can. And I know Ethan's got a lot on that because we had a thorough conversation about it. So I'd love to hear your thoughts, and I'll bounce off of it.
Yeah, so I was talking about this with Clayton 2 days ago. So we're looking at the market right now, and we're seeing terrible economic news while the market continues to trend upward. Typically, that wouldn't go hand in hand, but right now it is. One of the main reasons I brought that up to Clayton was because with inflation levels at around 6.3%, and interest rates at only about at most 1.5%. So you're getting a negative percent on your savings in your bank account. So what people are doing instead of holding money in their bank account is they're just buying stocks, they're buying crypto, they're buying equities, they're buying riskier things that could give them a higher yield. One of the reasons I personally believe why we haven't seen that market correction that everyone's looking for is because there are so many people that are just holding. They have no plans on selling. it's one major aspect of this bull run that has kept the bull run going. That no one wants to sell because they know as soon as they do sell, it's not actually selling and saving money. It's selling and you're losing 6% of that throughout the year. So that's like the first aspect we were talking about, Clayton. I don't know if you want to build off of that.
No, absolutely. I mean, there's a lot to unpack there. Guys, there's a small list in my eyes of catalysts that could really pull the market down. And a couple of those things is inflation spiking at a level where the Fed can't handle it, right? If inflation starts to go up in excess of 8, 10, 12%, that could be a catalyst to bring the market down. That also being said, that could be a very strong catalyst to keep the market as high as possible to offset the difference, right? A lot of these banks, asset managers, hedge funds, they are pushing the market up as much as possible so their clients, even with inflation, are still getting a good annual percent return on assets under management, right? So they need to keep the market up. That being said, the Fed can come out and say anything about tapering, can talk about interest rates, and we could have a 5 to 10% pullback, 10% being a full correction in the S&P. And when I talk about pullbacks, I'm specifically referring to the S&P 500. That's what I trade and look at the most. So that being said, you guys got to understand that even if you're just doing something long-term and you find a couple of vanguards that you like or something that really will hold its worth and do well annually, that is going to do better for you year over year and may just get you 2 or 3% more than how bad the inflation is right now. Because as of right now, if you leave your money in a savings account, you're losing very close to 6%. So consider that, please. If you guys are holding a lot of cash in savings account, if you guys are just sitting on cash all the time and it's not really ready to be leveraged, you're losing quite a bit more money now. It's not the interest rate is not 2%, right? So there is catalyst. There are issues going on with the inflation, and it's going to lose you guys money. And it's the unfortunate part about it is a lot of these big companies are not providing, an equalizer. They're not giving people 6% raises. I have friends at JP Morgan who got a 1% raise, right? And inflation's 6.2%. So I don't know. I don't know what we're doing here. So I think the market's going to hold up high, and I think the market's going to do well until the Fed or some other entity, specifically the Fed, steps in and makes a fundamental economic change for us long term.
So one of the most important things into that is when people look at the general market, they typically look at QQQ and SPY. But QQQ and SPY are really just tech and the top companies, right? So one of the most important things to look at nowadays is sector rotation. So this past week, we saw a massive, massive bull run in the EV space, right? You saw Blink take off, you saw Plug take off, Lucid, Neo. I actually didn't look at XPEV, but even Tesla had a run. So all of those towards the end of the week now are starting to pull back. And what we're seeing is all that money start flowing into tech. Amazon went up, Apple went up. What else went up? Uber, eBay. The only thing that's lagging is Twitter. Semiconductors are going up. What else is lagging though? Airlines, financials.
Yeah.
You have to find your plays based on sector rotation because the market isn't one and done. There are different sectors moving in different directions, and that's how you play. So, catching the bottom on the EV space, you have to make sure that it is the bottom, but play the momentum. Wait for a confirmation for a break. There isn't an ETF for the EV space, so you can't really look at green energy, electric vehicle altogether. You're going to have to play individual stocks on that, right? Financials, you have XLF. Energy, you have XLE. You can play the ETFs, and they're super easy to play as long as you know that sector is moving in a certain direction. One of the easiest ways to do that is every day, 9:30 a.m. You wait 5 minutes, 9:35 a.m. You go see it's on TradingView. I'm pretty sure it's on FinViz. You look at the stock heat map, right? And you sort it by sector. That will tell you which sectors are going up that day, which sectors are going down that day, and which sectors are pretty flat and they're going to chop around that day. it gives you much more of a direction of which stock I play today, either calls or puts. Yeah, and you want to make sure you're not singling yourself out to just calls and just puts. But I do swing my calls. So my way of trading is I like buying dips and swinging them, right? So I'll swing calls, but I'll day trade puts to manage the position, right? That's just to make sure I'm never, ever seeing a red day, right? I do see red days. It happens, but you have to make sure you're managing your position correctly and playing sector rotation. Because if you're not looking at sector rotation, you're just playing individual stocks, or you're just playing SPY, or you're just playing QQQ, and you're going to end up failing because you don't know where anything's moving. If SPY looks like it's going down, like today, before, first 20 minutes of the market, you would have said the market is crashing, the market is done, it's gone. And then we ended higher than we opened up, right? It was a straight V-shaped recovery, straight bounce. Actually, Clayton, I liked what you had to say about that before. So I'll let you go into what happened today with that massive drop to pop.
So, guys, in our server today, we were watching that through and through. SPY's one of the ETFs that I have on my screen at all times. I have SPY up all the time. And the biggest thing that we talked about today was on the downside. These were some of the largest candles on the 5-minute and 1-minute that we've seen out of SPY on the downside in a short time frame. So that was a huge indicator to me. And I was talking about this in the live call today. Retail traders can't create those kinds of candles, not alone. They just can't. Those kinds of candles are coming from unbelievably large short purchases. Maybe 10-20% of it has to do with put buys, right? Or hundreds of millions of dollars of puts purchased in SPY. Or, well, actually, yeah, it's more than hundreds of millions. But on the short side of things, this is the institutions that are bringing it down and creating that kind of a move. And what Ethan pointed out to me, which I agree with unquestionably, this is a book right out of the bank's Bible. There was a major wick that took out a whole, multiple million number of people that were trying to short and or get into calls and were literally cutting losses out on that wick, right? Hitting stop losses were cleared, whole 9 yards. SPY consolidated, and then throughout the rest of the day in a stair-step pattern, decided to go back up, but not in anywhere close to the same volume or capacity that it fell, right? In my opinion. So what we're looking for here is, if you see something like that, you got to understand, somebody like Ethan and I, even though we're trying to do well and we're progressing, we're getting our numbers up, we can't create that kind of market move, right? We just can't. And it would take hundreds of millions of dollars of purchases in order for us to do something like that. We're not institutions, right? And those are the people who are manipulating the market aggressively, and it happens every single day. And today it happened with one of the largest market cap ETFs in the market, if not I think SPY might be the largest market cap ETF. So that's one of the things I want you guys to take a look at. If we're talking about market conditions, understand that market conditions are created by people with large sums of potential equity that they're moving around, or liquid capital. And so there's still a lot of money on the sidelines.
So there's a thing in trading that we go over a bit called wick fishing. So wick fishing is when you have a specific level you're looking at, and something wicks. It's been respecting that level for days, depending on which time frame you're on. It's been respecting that level. What we're talking about by that massive wick clearing out the longs is when that level is taken and the bar will wick below it, the entire body will come below, and then the body will close above the level. So the wick is still dangling below that level, but the body closes above. And basically what that's doing is, institutions and market makers know that people have orders out, or people have shares that they're holding here, and they have stop losses set and all that. what they're doing is they're trying to make those stop losses hit. They're trying to make all the shorts get out, or they're trying to make the longs hit their stop loss. And then what they're doing is they're flipping it really quick. And the whole reason why they're flipping it really quick is because the move that they wanted to make money on wasn't the sell, it was the buy. And that's where they're making their money. So yeah, SPY dropped really hard, really fast, right? And it came up, but it took a little bit of time for it to come back up. It took, it consolidated right after the drop. People needed to understand what was going on. Institutions were getting their shares, getting their contracts, and then pop, pop, pop. And then what we saw SPY hit a major rejection level, and it had two little red bars and then a big red bar, which means that sellers were still there, and this is not a safe market to swing anything in. So really what we're looking at, and I wish I could share my screen with you guys, but what we're looking at on SPY is we're looking for SPY to get over this 470 level, this 469.90 level, which it looks like in the after hours it did. But what we really need is over 470.50, right? That will give us that pure confirmation of, okay, institutions are back into this. And we have to make sure that we see a break with volume, right? If we just see a break over resistance and it trickles up a little bit, don't hop into calls there. It's going to come right back down. It's either going to retest the level or it's going to invalidate the level and go below, right? Institutions will take levels, and when they see something break, if they want to buy on the break, what they're doing is you're seeing like what happened with Apple today. Apple had a resistance that it needed to break. Once it broke over, Apple skyrocketed. It had this resistance level at 155. Once it broke over 155, it didn't just trickle up and keep going. It shot up in two sharp candles. That's institutional buys right there. Those are institutions buying in at that level. They might be doing a day trade. They might be doing a long-term thing. We don't know. We can only take that level as, okay, that's a respected level by institutions.
Right. And we had the major news come out about Apple's EV projects, if I remember reading that article correctly.
Yeah,
so
LDR went off too, all the LiDAR technology companies.
Yeah, there you go. So Ethan just covered so much that is so crucially important to you guys looking at the bigger picture of what you're trading. Apple's vertical run that we're seeing on that 1 minute chart or the 5 minute chart or whatever chart you want, but just I'm talking about today, that vertical run was unquestionably institutional buying power. And they had fundamental reasons to take that trade, and they also had technical reasons. I have resistances all over 154 high and 155, and that was our breakout point. And I do not day trade like Ethan, but today was a great day for me because back in September and October, I was getting in January, February, and March credit spreads. And today I was taking multiple legs out for well over 30 and 40%, which I was very, very happy about. But if I'm buying dips and I give myself enough expiration, my theory is, and I keep this very simple, obviously there's a lot more complexities behind the strategy. It's not this simple. But if you're buying something that's so heavily discounted, you give yourself 8 months for that to recover, chances are you're going to be able to do well, right? And I specifically focus my credit spreads on ETFs now. But with Apple, I've been waiting for weeks from the end of September when I entered into these. I waited all through October, and now we're in the middle of November. And I'm just now getting out of these credit spread positions for 30 and 40%. And it just took that move going up for me to rocket into the positions that rocket into the profit that I wanted. And I just kind of sit and twiddle my thumbs. I was not doing anything today except taking a very large SPY scalp when SPY fell to the scalping to the upside. Other than that, I was just talking to everybody today. I'm a long-term trader. I didn't have a lot to do. And Apple broke out, and then I just started hitting the sell button for a bunch of my legs.
Yeah.
That's what the days look like.
I was telling Clayton earlier, I'm not looking for 100% gains a day. I'm not looking for 50% gains a day. I'm looking for 10%. I'm looking for 20%. I'm looking maybe even 5% sometimes. So today on SPY, I was literally just looking for a quick little scalp. So I was telling Clayton I got into 468 puts at 0.9, and I sold the majority of my contracts at 0.99. Yeah, they ended up running to 1.36. It sucked. You're looking at that, you're pissed. But I made 10%. right? I'm happy. I made my 10%. I got to play spy puts later in the day too. Made another 5% on that, right? And it adds up. Your 5% adds up. Your 10% adds up. You just got to make sure that you are following your rules. Clayton is a profitable trader. He doesn't trade like me. He's very much long-term oriented. Me, I'm long-term and short-term, but mostly just long-term with stuff that I'm holding until I'm 50 years old. All right. The short-term stuff, we're looking at the same levels. We're looking at the same things, but I'm playing the short-term and he's playing the long-term.
And that's why I hyped this conversation up so much in the live call today, because all of my questions are how to wrap my trading strategy in a much shorter and narrower time frame. So, I hope a lot of the OBR guys that are in here are taking notes on what it is that you do. Because again, Ethan, same outlook here, right? Same exact outlook. We're looking for the same large institutional moves. We just have different time frames, and we're leveraging differently, and we utilize different vehicles, right? You're doing naked calls and puts, which is fantastic because you're so conservative and so disciplined with how you're entering. I'm doing credit spreads because, on a shorter time frame, I don't have that discipline. So I need a little bit further help with not getting attacked on theta long term, actually having theta benefit me, and the volatility not hurting me as much. And if I know that both of those things are working in my favor, my mind is calm. Stress has been alleviated for the most part. So two different trading strategies, very similar trading outlooks, which is why I was so excited to talk to you tonight, Ethan. Is there anything else you'd like to add? Is there?
Ooh, I lost you a little bit there. Hold on.
All right,
I lost you a little. Yeah, I got you.
Okay. Is there anything you'd like to add before we start taking some questions?
So the only thing that I'd say is I've always wanted to say this publicly, but you guys shouldn't trust technical analysis. And what I mean by that is trend lines. When someone says a cup and handle, really all a cup and handle is a double top. When people say a double bottom, really all a double bottom is a confirmation of a support. That's all it is, right? Trend lines aren't a real thing. They might be, but they're really not. Institutions aren't following trend lines. Trend lines are just, this is the direction it's going. You still have to respect the levels it's at. The levels are the keys. The institutions aren't buying things because, oh, this is on an uptrend and it just hit the trend line and it's coming back up. Institutions are, we like this stock at this price for buys. We like this stock at this price for sells, and we're going to adjust our sentiment as the year goes on, right? And they're moving their numbers constantly. So they're looking at specific levels. What you guys have to understand is those levels are the levels that you should be looking at. Sometimes they're dark pool levels, not all the time. Dark pool is a really great thing to look at. You have to make sure that the sizing of the dark pool, you're taking the sizing of the dark pool into account. So a $500,000 dark pool, $500,000 dark pool, I'm not giving the same strength as a $20 million dark pool. Right, that $20 million dark pool obviously is going to act as a stronger support or resistance than the $500,000 dark pool. One great app for that is Black Box Stocks. If you guys are interested, it shows it right on the chart. There are a bunch of other ones too, like Flow Trade and Cheddar Flow, that they're going to give you dark pool prints. But Black Box Stocks is the one that shows it right on there, and I use it because if I miss a live dark pool print during the day, then I'm able to go back in the after hours, pull up the chart, and I can see those institutional levels. Dark pools aren't always institutional levels, but they're levels that have to be. Clayton, I'm open to questions now if you are.
Okay. Well, no, I appreciate you bringing that up. Super important. I stopped using technical analysis other than to look at a higher time frame and see, hey, if this security has fallen this far in the past, chances are we could see something like that. And that's where my buy zones are. I keep it very simple. If it doesn't hit my buy zones, I don't buy it. I just don't.
Yep.
And because chances are, sooner or later, I'm going to get a correction that brings it back to a buy zone that we hadn't seen for 2 years, right? And I'll be there when I see it, right? I'll be there because I'll have those zones mapped out for supports. Mm-hmm. And I just stay conservative. I'm in no rush to buy anything. I'm in no rush to potentially lose money, having to average down or say that again.
You're not chasing anything. You know your level. So there's no reason to enter early. There's no reason. You just wait for your level. You get in, pop.
Right, right. And guys, I only trade mega caps, right? So there's so much money behind what I trade that it's very difficult for them to fail. And if they're hitting major supports, chances are there's something going on institutionally. They're trying to pull the stock down, and they're going to be ripping it up real soon so they can cover their long positions. In the story. In the story. So let's take some questions. A couple questions here. We're getting close to 6:30. If you guys have any questions, let's throw them in. Ethan, I want to thank you. I want to thank you again. You got a question already.
So I use black box stocks to track the dark pools. There's a bunch of different order flow services. So I use black box stocks. I was told that the most beginner friendly one is Cheddar Flow because you can set specific filters. So I'd recommend Cheddar Flow if you're new. If you're a little bit more experienced, black box stocks. But either one is really great. Flow Trade looks like it's from the 1980s. Please don't use it. It's so hard to use. I can't even use it. I'm not shitting on Flow Trade. That's just like, it's fucking impossible.
Right. I got you. Yeah, no, I'm with that 100%. So another question is, what's a good website to learn that isn't technicals or technically, related to TA, I assume?
What's that site called? Option Alpha? Is that what it's called?
That's what I used to use. Absolutely. So that's a good neutral site. Options Alpha has podcasts that go over TA. Guys, just to not even to plug either of us, just where I learned from, just to remove yourselves from everything, like me as a human being. I used Options Alpha and I used In the Money on YouTube.
Yeah.
Now, In the Money's great. And I can plug both of us. We've got educational background. We've got a bunch of stuff in both of our servers. That's not a problem. And if you guys want Ethan's contact information, you reach out to us for it, you're going to get it. No problem. Whatever you guys need from him, you get it.
Followers, you guys want anything OBR, just let me know. I'm going to link you right to Clayton.
Perfect. And I appreciate that very much. So you guys will have full access to both of us. The reason why we have these calls is so that we can bring two platforms together and see if we can share different perspectives to hopefully give you guys some aha moments or some clicks, right? Or some light bulbs. But we both care about one another and what we're doing. So we're here to support one another and we're here to support you guys, which is why we're taking time to give these live calls and provide these to you all. So another quick question. What would be a good monthly investment into a portfolio? Well, the biggest thing there is it depends on what you can allocate, right? Every month you have your expenses, you have your income, whether you have a 9-to-5 or a business, you have to be able to allocate accordingly. If you have $10,000, that's going to be different from somebody who might be bringing in a larger amount of income or smaller, right? And it also depends on what your expenses are and what you're paying in taxes. So if you can provide a proper allocation, for me, my budget is a little bit more strict and a little different from most people. My income is 90% and my expenses are 10%. And it used to be 20-80, now it's 90-10. And I try to make sure I'm making more each month rather than spending more each month. And that allows me to reinvest that 90% into my portfolios monthly. So that's what I do.
One recommendation I actually have, and this is like kind of hard. It takes about like 3 months to fully set up. For 3 months straight, write down every purchase you make, every expense you have, every inflow of cash you get. Put it all down on a spreadsheet. Do it for 3 months and then take the average, right? If your income, let's say, is $5,000 a month and you have $1,000 a month in expenses, you have $4,000 in extra cash a month, right? You're saving a little. Let's save half of that. Let's put $2,000 away, right? Like just put into a savings account. Cash is king. Not right now, but cash is king. So you just put that away. What you can do with that other 2,000 is what basically everyone's question of how do I long-term invest. You don't want to put every last bit of savings you have into the market at once. So averaging in is the perfect thing to do. I'm one that I tout weekly deposits. Deposit $100 into your account every week. If you can't afford $100, $20, doesn't matter. Go buy yourself lunch. Whatever lunch was, put it into your account, right? Do that every week. It'll add up. And what you're doing is you don't have to take risky trades like options, because what's going to happen is if you keep putting money in $20 every week, $100 every week, you're not great at options trading, or you're not really focusing on the education part, all that money you're saving into your options account, into your trading account, it's just going to disappear, right? So the whole point of that weekly deposits is so that you're buying stocks that are fundamentally good stocks. So I'd say I think Apple is like kind of a weird company to invest in. Anything that's over $1 trillion, I think it's like weird to hold long term, but it's Apple. You can hold it long term. So I'm just going to use Apple for an example. You deposit $20 a week into your account, right? Robinhood has this great thing called partial share buying. So you don't have to buy a full share of Apple for $157. You could buy $20 worth of Apple. What you do every week is you buy another $20, you buy another $20. Oh, Apple came down, I'm going to buy another $20. Oh, it went up, I'm going to buy another $20. As you do that, what you're going to see is if Apple keeps going up, which it should over the next, and I'm not talking about going up like within the next year, I'm talking about like the next 20 years, right? If Apple continues to go up over the next 20 years, which it should, that investment should also go up. It doesn't matter if you keep averaging up. Your average is always going to be lower, right? As long as you're dollar cost averaging, you're going to be fine. There's no wrong time to enter the market. It's just all about how you do it. If you do it correctly with dollar cost averaging, perfect.
That's some of the best information that we can provide you guys. That is so unbelievably important. I talk to people who have full-time jobs every single day, a handful of people, different every single day, if not the same people over and over again. And one of the things that they're doing to build their wealth is they are concentrated, but they buy 1 or 2 ETFs. And if they have $5,000 coming in a month and they can only invest $2,000 a month, they're doing $500 every week. $500 every week. So their average cost, they will always have money in at every single price that the S&P 500 provides over a weekly basis. And that's fantastic. And then you can go a step further and you can use $1,500 and keep $500 in cash. And you can build up a large cash store for when, if you're checking the market every couple days, you're going to see, holy cow, SPY's down 5% this week. Maybe this is time where I deploy some of my cash, right? So that's another thing that adds into the averaging down. But I think we can end it on that. If there's anything else you'd like to bring up, please.
I'm good.
Okay, perfect. Ethan, I really appreciate your time, and it's an absolute pleasure speaking to you. I've loved our introduction calls. I've loved meeting you, so I am very much excited for us to dive a little bit deeper in future topics.
Yeah, definitely. Thanks for having me. I hope to be back on soon. I'm happy we literally align on most things, so it's just easy to talk to you, bro.
I think we align on everything except I don't day trade.
I hope your followers enjoyed. The guy who's asking about NFTs, yeah, I'm in NFTs. I'm not going to go into it. I think there's a bubble. Just that's all you need to know. Get the ones with utility.
And guys, just to say that, there you go. So, and just to say this, we're going to be keeping a tight schedule. I'm going to be running these IG lives every Wednesday, every week. We're going to make sure we're dedicated to providing you guys as much free and applicable information as possible, so that you guys can be in here, hop in these live calls. And then Ethan will be back in a couple weeks, I'm very sure.
Yeah, 100%. I actually like how this is set up. I might host one on my own too.
There you go. And I'm sure you're going to do, I know you'll do very well. So good luck with that. And I will chat with you later. Take care, guys.
Have a good one, guys. Peace, Clayton.
See you, brother.